This video will give you 5 things to do to take over more control over how much tax you pay to the government. But there's a little bit of time left before the benefits of the Tax Cut and Jobs Act goes back to previous levels. We're not certain how this 2025 sunset will impact family estate planning, but many people are taking advantage of some of the preferential treatments now. And you don't need to have a lot of money to get the benefits of some of these strategies. Actually, number 2, 3, and 5, the ones that we go over today, these will be the most beneficial if you're trying to reduce estate tax and do some family planning. But number 1 and 4 can be useful even if estate taxes isn't that big of a concern for you, but you're just interested in how to save money and not pay too much to the government. There's a few benefits of the Tax Cut and Jobs Act that are going to be scheduled to revert back to the 2017 levels. Things like the high lifetime gift, the estate tax and generation skipping tax exemptions could be going back to the previous levels. So I'll share what that means and then share a few ways that you could potentially help you and your family reduce the future tax burden of your family. Because remember, your money can really only go to 3 places. It's either going to go to your family, causes you care about, or Uncle Sam. And most of our clients, they usually prefer 2 out of the 3 of those where they want to leave their money. And you've probably heard it before that, paying taxes is fine and we'll pay the fair share, but we don't necessarily have to tip Uncle Sam. And something tells me that you might be able to use your money a little bit more efficiently or effectively than what the government is doing. But before we get into these, welcome back. I'm Dave Zoller, and if I haven't met you yet, this channel is here to help make your retirement a little bit better. I own a retirement planning firm with Tim, and we get to help people one-on-one with our team. But we want to share what's been working for some of these high net worth families with you as well, so that hopefully many people can benefit from these strategies. Before making any substantial changes, though, to your estate plan or just plan and finances in general, be sure to consult with your financial advisor or estate planning attorney to just ensure you're making the right decisions before you make anything happen. So the first strategy to know about is the annual and lifetime exclusion gifts. This can be useful whether you have a lot of money or a little money, but helping kids is important to you while you're alive. In 2022, the annual gift tax exclusion amount is $16,000 per beneficiary. So what does this look like in a simple drawing? So $16K is what you can give, and if you're married, another $16K. So essentially, $32,000 you can give to your kids or really any beneficiary without having to file a gift tax return. But if you do go over, then it's recommended that you do file one. So staying under it just makes things just a little bit easier. And if reducing your future state tax is important to you, the IRS said that taking advantage of the annual exemption amount now is not going to be negatively impacted after the 2025 sunset, when the Tax Cut and Jobs Act levels are expected to go back down. So in my opinion, it seems like gifts made under the current exclusion amount should not be subject to future estate taxes, which is good. The next tax-efficient wealth transfer strategy is education funding. So the IRS allows anyone to pay educational expenses as long as it goes direct to the institution, essentially removing assets from your estate without a tax impact. And some institutions allow you to prepay a few years, multiple years at once of the education expenses. Another education funding vehicle is a 529, and that's an education savings plan, which you should be able to contribute up to the annual gift tax amount per year each year again. So this picture right here, but getting into a 529 instead. And some of those 529s, they even allow you to take a tax deduction on your state taxes. Now, each state is a little bit different when it comes to that. There's different sets of rules. So just be sure to talk to your tax person or financial professional before doing that. Now, the third strategy, it's similar to education funding, and that's just paying for medical expenses if you pay directly to the provider, and if the expenses are not covered by insurance. It's kind of the same impact of paying education expenses, but just for medical. Now we've got 2 more strategies to go over, but first, if this has been helpful so far and you like these short videos on some of these strategies, please click the like button or share this video so a friend or someone else can benefit as well. Now the next strategy that can be useful is if there's certain things happening in the world that just kind of break your heart and you really have a desire to help, you can make an impact in the world and you can save money on taxes through charitable planning, especially if you have investments that have appreciated and gone up in value over time, or if you have real estate, or if you have business interest. Here's an example of what that looks like. many people are using donor advised funds that allow you to give a portion of something that's pretty much illiquid, but allow you to actually gift that to a donor advised fund. So let's say you had 5% of a building that had appreciated in value. You could essentially give 5% of that building, which is then sold and then converted into whatever investments you want in here. And that day that you give the gift should give you, or I'll put a little U over here, should give you the tax deduction or tax benefit that year. Same thing can happen with business interest. If you carve out a piece that you choose and gift it, you can get that tax benefit, that tax deduction. And that appreciated asset or piece of an appreciated asset, when it's gifted and when it's sold within the donor advised fund, that doesn't cause a capital gain for you. So it's one way to not only not pay tax on, or capital gains tax on part of your appreciated assets, but it's a great way to fund your giving expenses in the future, or what will be giving expenses. Do it now without impacting your cash flow. Now, there's all sorts of rules around this. Again, this is high level, big picture view, but I want to give you an idea of what some other people are doing that's really benefiting them and benefiting some of these charities, because really now you've got money in a donor advised fund, but what are the places that you care about that you would give to, the charities or causes or places that you wouldn't mind helping support? And you can either do one-time gifts from this thing. This is kind of like a charitable bank account where you get to control the outflows and where it goes, but you really don't include this in your estate, your total estate. It's technically out of your estate. So you get to control it and where it goes. You can either set it up on one-time payments, or you can set it up on monthly recurring to charities that you care about. So again, a lot of rules around this. This is just big picture. Talk to someone about specifics before implementing something like this. If you're interested in learning more about what's possible with your giving, click on the charitable planning strategy session below. It's not a call to work together as we do with most of our clients. It's strictly just to talk about your giving strategy and then to help you develop one if you don't have one. So check that link if you're interested. The next strategy is to think about various types of trusts that you have available to you right now. These trusts are sometimes used if you don't want to give assets directly to beneficiaries at this present moment, but maybe at a later date. Some of them allow you to have control over the assets until the beneficiary reaches a certain age or a certain requirement. And one is called a crummy trust that allows the grantor to determine really how long the assets should remain in the trust, which gives some control over which beneficiaries can, or when beneficiaries can take full ownership. And there's also charitable trusts that essentially allow a charitable gift into a trust and then allows you to receive an income while you're still alive. And then when you pass away, the remainder goes to the charity. So that's another way people are sometimes using estate plan or charitable planning when related to estate taxes and estate planning. So hopefully these 5 strategies give you some idea on how you might be able to lower future estate tax liability for you and your family. For more helpful resources on things like this, check out the links in the description below this video. I hope it was helpful for you. If it was, please like the video and subscribe, and then I'll see you in the next one. Take care.